Hello and welcome to KYC Know Your Company right here on NDTV Profit. My name is Puneet and today we are going to be looking at a very interesting company in the Electronic Manufacturing Services or EMS space, and that is Syrma SGS. Now, let's first look at why we have picked this particular company today to take a holistic deep dive into what it does, as well as some of its key strengths, weaknesses, as well as how it favors or maybe compares to its peers. Currently, for Syrma SGS, valuation is one of the key triggers, and we'll talk about that in one of the key parameters as well. If you look at one of the key other aspects is, of course, the company is looking for a turnaround that has started over the last 2 quarters. Again, something which is, I'll give you a spoiler, is right on margins, and we look at that in detail as well, and a substantial change that the company is going through within its product segments that it operates in. So those are the 3 key reasons why we will be looking at this company today and take a holistic deep dive into this one. When you look at the key parameters as well that we will be looking at for KYC today, essentially the first will be in terms of the income statement will be some of the key things that we will be looking at. Apart from that, if you can pull that up on the screen very quickly, that will be the first parameter. We'll also be looking at the balance sheet, the cash flows, as well as return ratios, and give a key rating for all of these. Apart from that, we will be looking at the shareholding, the street credentials, as well as the street coverage on the stock, and finally, a relative valuation picture of how it compares to someone like its peers in the EMS space. Let's first look at what the company actually does. In terms of introduction, Syrma essentially is an integrated electronic manufacturing service player. As I mentioned, for someone who doesn't know, EMS essentially is a player that manufactures for other key companies. Now, that could be somewhere in the consumer durable space, making refrigerators, electronics, air conditioners is one of the key other parts. And currently, they have 14 manufacturing facilities in India. Apart from that, the company also has 4 global R&D centers that it has all over the world. They also have one in Germany for more research and development purposes and entering more nuanced engineering products as well going forward. Now, to understand more about the company, let's look at the 5 key current segments that it operates in, because within EMS as well, we have a lot of companies that focus on mobile, such as Dixon, but for Syrma, there are key 5 segments that you need to know about. First is, of course, the automotive side, where it focuses on EV mobility as well as accessories. That's for almost 1/5 of its revenues. The second key aspect is the industrial one, and this is expected to be the lead in terms of revenue going forward. It manufactures products like smart meters, solar controllers, as well as industrial cleaners. The third one is consumer, and that's something that's common across the EMS players, but within consumer as well, there's multiple products that we just spoke about, like refrigerators and air conditioners. For Syrma, they have some, essentially some mode in BLDC motors, something that's used in fans. They also manufacture Wi-Fi routers as well as modems as some of the key products for the company. Apart from that, in the IT and railway space, the company manufactures a signaling system, which is a key product in terms of margins as well. They also manufacture something like controllers, braking systems, and that's all for the railways as well. Within IT, it also has in PLI for manufacturing laptops. Well, currently something that the company is looking at very closely. Finally, the 5th segment is healthcare. They've also done an acquisition in this space over the last 18 months. They manufacture medical devices as well as diagnostics and therapeutic products, something that they are keen to grow in terms of revenue. Now, within the 5 verticals, let's look at how the split is for the revenue per se. For FY25, we've seen the consumer share actually just grow very minusculely, just by 7%. And that's something that the company's strategy has been to reduce the share of consumer space. The other 2 segments I want to focus on is, of course, industrial as well as auto. You've seen this has almost a very high growth on a very substantial base as well. And the key reason for that is looking at high margin products. That will, of course, improve the EBITDA as well. And that's one of the key strategies that the company is focusing on. The other 2 verticals, IT railway as well as healthcare, we showed you the products currently that it operates in. It has high margins as well. Currently, within the total revenue of about 3,700 odd crores, it's a smaller share, but it's one of the key focus areas for the company. So those are the 5 key segments that the company operates in. We've told you about the products as well. But now it's time to look at the key 8 areas that we spoke about. And let's first start with the income statement. Now, when you look at the company's performance in terms of income statement, that has been very solid at 3,700 odd crores in terms of revenue for FY25. And if you also look at the last 3 years, it's grown at a CAGR of 44%. Now, within the EMS space, a high growth in terms of revenue is something that's not very, it's not very uncommon, so as to say, because it's very high in terms of, scale that they manufacture at. But that's also, a positive for Syrma because they've, held pace in terms of EBITDA margins as well as expansion as well. Currently at 8% EBITDA, the whole overall EBITDA has grown by roughly 33% CAGR. Profits have taken a 33% CAGR growth as well, coming in at 169 crores for FY25. It was almost one of the highest that the company has done since its listing back in 2022. So we've given this a thumbs up based on the growth parameters for the company. Let's now look at the balance sheet as well, and that's something that's key for all EMS players because you need very high working capital for this because the cycle of cash coming back to you, and we look at it in the cash flow as well, is also very elongated. In terms of shareholders' equity, it's roughly about 1,800 odd crores for Syrma. They also have a very minuscule net debt of just 0.2 times when you compare it with the equity portion of the business. So we've given this a thumbs up as well. Apart from that, they've also maintained a very strong cash balance of 295 crores. And it's something that the company has been mentioning because within the EMS space, acquisition is also one of the key strategies to acquire new technologies as well as products. So definitely a higher cash balance will be something to watch out for. But for balance sheet as well, we've given it a thumbs up, low debt, high cash, as well as decent shareholder equity as well. When you look at the cash flow though, the picture is slightly different, and the key reason is the net cash flow. In terms of the cash flow from operations, this is essentially what they generate from doing their business. It has grown steadily over the last 3 years, but we've seen a very substantial jump in FY25. The company just reported its results yesterday, and we'll also be speaking to the management as well. My colleague Harsh has caught up with them. But in terms of 3-year CAGR, the strong growth in terms of cash flow from operation is a positive. What is not positive, and hence we've given this a neutral rating, is the net cash flow. They have been investing heavily in manufacturing facilities, and for EMS players, that's a big expense. The cash flow from financing, which is CFF, that's also taken a knock over the last 3 years, and hence the net cash flow from operations is just about 1 crore rupees, and it's a fall of about 42% CAGR over the last 3 years. The key aspect is also that the company has been changing the product mix, reducing the consumer share as well as increasing the other aspects, but that has required higher investments, and hence the net cash flow number is slightly, it's more than slightly, it's actually a negative, down 42% CAGR. So we've given this a neutral rating, at least for now. They are on the strategy to embark on generating higher free cash flow, and that will be something that will be a key monitorable as well. Those were the 3 key parameters of the financials of the company. Now, let's look at the other key aspects that you need to know. In terms of, the next key aspect for something like a Syrma is, of course, the return ratios. And here is, again, a key negative. In terms of return on equity as well as return on capital employed, the company just has 10.2% in terms of both these metrics for FY25. And while this has been stable over the last 3 years, for players like Dixon as well as Keynes Technologies, their number is almost 30 to 40%. And hence, the business hasn't been generating enough returns for the capital employed that they've been doing over the last few years. While this has been a turnaround strategy for them, it's very, very recently. So these return ratios are expected to just go upwards from these levels. But over the last 3 to 4 years, they maintain a similar level of between 9 to 10%. And when we compare it to the peers, it is a key disappointment. So we've given this a thumbs down for both these return ratios as well. Now, let's look at the shareholding as well. And here it's where it gets interesting. Because while the company's promoters' holding has largely remained stable at 46%, we're seeing an increased interest from public as well as retail investors, almost 39% stake. When you compare it with the other peers as well, for something like a Dixon as well as Keynes and Amber Enterprises, their retail holding is roughly between 10 to 20%. So definitely a stock that's in favor of retail investors. And I think the valuation has got to do something with it. We'll look at the valuations in a bit as well, but largely stable promoter holdings, a higher interest from the public investors. And we've also seen the FII data also increase in terms of stake for the company. So hence, we've given this a thumbs up for now. The shareholding largely stable, as we just mentioned. Now, the other key aspect is the street coverage. In terms of the EMS space as a whole, the street cred, essentially, let's look at that first. The street cred has largely been, stable because the company listed back in August of 2022. At that time, the IPO was priced at just about 220 rupees per share. It listed at 262 rupees per share, which was a 19% premium at listing. So that is one of the key ones for investors who've held on. Currently, the share price is roughly between 530 rupees per share. So definitely a 70% return since listing over the last just about 3 years. Definitely a very solid return. The key aspect is we've given this a neutral rating because it's underperformed its peers by a mile. We've seen something like a Dixon Tech that's up 17 times. So that's roughly 1700% over the last 3 to 4 years. While players like Keynes Tech is up 600 to 700% in terms of returns. And when you compare that with 70% of Syrma Enterprises, it's a very big negative in terms of relative. And that's the key reason why it's slightly tricky for EMS companies, because we have to look at the company's performance, but also compare with its peers how they've been doing. Dividend yield largely stable at 0.2 to 0.3%. Again, not much to write home about, and that's largely because the company has a very high investment plan as well. So we've given this a neutral rating for now. The dividend yield isn't expected to go up meaningfully, but the company's performance has to improve to get the returns for its investors as well. Let's now look at the street coverage. Very healthy street coverage for Syrma SGS. 24 analysts is what track the stock as of now, and out of that, 20 have a buy call actually. Let's look at very quickly the street coverage as well. If you can pull that on the screen, that is one key aspect. There is 3 hold ratings for the stock and 1 sell rating. There you go, flashing on your screen right now. So, and that's largely to do with the valuations as well, because it's projecting another 14% upside from here. Very interestingly, we've just seen over the last week, the stock was up 17% before the results came in on Tuesday. So definitely is something that the investors are looking at in terms of growth over the next 2 years. But 20 buy calls for analysts at a valuation. We've seen the last 12 months return also at 33% in terms of returns. So it's been a strong year for Syrma, and analysts also projecting another 14% upside. Finally, in terms of valuation, and here is where it gets interesting as well as slightly tricky as well. Because we've seen players like Dixon Tech, Keynes, as well as Amber Enterprises trading at very, very high valuations over 50 to 80 times. We've seen something like Keynes Tech actually at 97 times price to earnings. And those numbers are very, very stark when you compare it with Syrma at 29 times price to earnings for FY27. Now that largely can be projected because of the growth. The growth has been slower for something like a Syrma, and hence those earnings per share growth hasn't also been coming into it, which is the bottom line for that formula. Essentially, it's something that the company has taken a very structural call on reducing the share of consumers, and that is one of the highest revenue growth verticals as well. So that's one of the key reasons for something like a Syrma. We also had a couple of other players in terms of valuations, PG Electroplast as well as Avalon Tech, both trading at roughly about 42 times and 40 times. There you go. PG Electroplast, large consumer play with air conditioners. For Avalon Tech, they've also been looking at increasing their share in terms of consumers. So the revenue growth is one of the slowest in terms of, for Syrma SGS over the last few years. And that could be something that could continue going forward, but they are looking at increasing their EBITDA share as well. So we've given this, we'll come back to the rating in a bit, but what to watch now is something that I want to talk about. And the key reason is because there has been, we've told you about what's happened in the past, but there's a lot more that you need to know about this company because the valuations are quite in favor when you compare it with its peers. The company has taken a structural call to reduce the revenue coming from the consumer business, which is the low margin product. That's something that investors have actually liked as well, because they've reduced the consumer share from 40% to 35% in this year. FY25 was 35, FY24 was roughly 40%, and that is expected to go down further to just 30% in the next year. What that will do is increase the EBITDA margins for the company. They are projecting FY26 EBITDA margins to be somewhere around 8%, and that's one of the highest, because something like a Dixon Tech is at 4% margins because they have high consumer share, which is mobile manufacturing. So definitely something that the company has taken a structural call on to have lower contribution in terms of revenue from the consumer verticals as well. Management is still expecting a growth of about 30 to 35% in FY26. That could largely come from the industrial as well as the auto vertical that we spoke about as well. The legacy issue of margin decline has largely reversed over the last 2 quarters. We've seen margin growth after a steady decline over the 5 quarters as well. So we saw 5 quarters of margin decline. The last 2 has seen margin growth. And again, that will be something to watch out for. The company is expecting margin growth going into FY26 as well. So what does it do for our final ratings? Let's pull that up and look at the ratings now, because we've given this a 6 out of 8. When you look at the income statement as well as the balance sheet, it's a thumbs up, a neutral for cash flows. The return ratios we spoke about is a negative. Shareholding is largely positive because of high public as well as promoter holdings. Street coverage is a big thumbs up as well, 20 analyst buy calls, and valuations very, very much in favor when you look at the company in terms of relative valuation as well. Hence, we've come with a strong rating of 6 out of 8 for the company. It's quite similar actually to what its peers have done, and the company's share in terms of revenue is something as well from the consumer business is something to reduce, so margins will be protected going forward as well. But let's now move on and hear from the management itself. My colleague Harsh earlier spoke to Managing Director J.S. Gujral, who spoke about the company's growth prospects ahead. Listen in to a slice of their conversation.
We achieved a top line of about 3,800 crores this year in FY25. Going forward, I think we would be growing at about 30 or 35% for the next year, and maybe at the same percent or marginally higher or marginally lower percent in 26, 27. So I don't think that matches up to the 6,500 crores. My growth will be about 30, 35%. What we had shared earlier this year, that we are recalibrating our strategy to focus on high margin verticals. And that is essentially the industrial, the healthcare, and the automotive. And I'm very happy to share with all of you that in the current year, we have been able to bring down the low margin consumer business to about 35% of our revenue, which was a target which I had set for ourselves. And the balance 65% is a high margin business. Going forward, we'll try to recalibrate this again and endeavor and bring down the consumer business to below 35% or closer to 30% by the end of this year on a year-on-year basis. Now, if that was to materialize, then I think we are on track to achieving superior EBITDA margins of about 8%.
Point taken. So 2 pieces here. One is with regard to your top line, expected to be at around 5,000 odd crore. That's a 35% growth in FY26. Maybe another 30% in FY27. So around 6,500 by FY27. For FY26, the understanding that I gather is you're bringing down consumer. 2 things. Are you degrowing the revenue on consumer? That's point number 1. Point number 2, give us the rationale. Is it just margins that you are chasing, and therefore is this a conscious calibration?
You see, we have to calibrate, and it's a very conscious calibration to recalibrate the product mix or the vertical mix of the business. And we would like to sort of concentrate on our core competencies, which are automotive, industrial, and healthcare. And renewed focus on this. These contracts typically take longer gestation period than plain play consumer orders. So going forward, our focus would always be to grow these three verticals, and consumer would continue to grow. We would be a bit more choosy in our selection of consumer business, with the idea that we keep growing at 30 plus 30 odd percent growth with superior EBITDA margins.
Okay. So, sir, give us perspective. What is the margin on the consumer business versus healthcare? If you can give us that perspective.
See, the high volume consumer business is a very thin EBITDA margin business. And I think players which are there in the industry, which are focusing on that, the figures are in public domain. It would be sub 5%, 4%, 6% of EBITDA margins in the high volume, low margin consumer business. In healthcare business, industrial business, these margins tend to go up. Healthcare, because it's my own design product, the margins are very, very superior. And in industrial, they are upwards of 12, 15, 10, 12, 15%, depending on the vertical of where we are supplying within the industry.
So healthcare, I take your point. It's your product and therefore you have a niche. What about industrial? Do you believe that eventually margins could erode there, or what's the likely risk of that?
See, when I internally review my margin profile vertical files, it gives me a big satisfaction that there has been a margin accretion in each of the verticals. We have not seen a degrowth of margin profile in each vertical. Now, as my export business goes up, it will help in sustaining the margin profile. And the reason for a comparatively higher margin in industrial is very simple. It's a low to medium volume, complex boards, high value. So it gives me a lower asset turn, but a higher margin.
Okay, interesting.
And we'll be sustaining the margins. I think as we are growing in size, we get a better clout in our sourcing, strategic sourcing. So I don't see the margins declining in these verticals.
Point taken, sir. So what about IT hardware? Because what we're hearing, what analysts seem to be suggesting is that IT spend may pick up significantly given everything that's happening around tariffs. Give us your perspective, one with regard to the macro setup, and second with regard to where you see the IT hardware business going. And is there any PLI accrual there? Is there any chance of a PLI coming in for you over there going forward as well? Just give us that entire picture.
See, on the IT, we are a recipient of the PLI announced by the government of India, IT PLI number 2. But that kicks in when you start making the end product with at least motherboards and some other components also being manufactured within your compound or within India. If we were to only assemble the computers or laptops or other thing, the IT PLI does not kick in. We have started assembly of laptop computers with MSI of Taiwan. I think it will be a while, maybe during the year as the passes by, that will be integrate the backward integration of manufacturing motherboards and some other components, piece parts, modules of the laptop, which will make us eligible to claim the PLI.
So how far away are we from that point?
See, currently what we are doing for our customer is the domestic demand, and domestic demand being limited because these are high-end laptops. It does not make economic sense for the customer to manufacture the motherboards in India because the volumes are currently small. This was started off about 4 months ago, and the lines having stabilized, I think there's a very good chance that in the coming year, I may get integrated to his global supply chain. And once that happens, then the probability of doing the backward integration of motherboards and some other modules in India, in our factory, is reasonably high. And I think that's the time when the PLI will kick in. But I think we'll have clarity about a quarter or maybe 4 or 5 months from now.
Okay, so I've covered a few of the segments. Let me look at one forward-looking segment that you were considering, OSAT. Where are we with regard to that business? Are you going to actively look at it?
OSAT, our sort of contention and our rationale has been very, very clear right from day one. It's a decent segment, separate segment, thin margins, deep pockets. But we would go in it only if we have a credible technology partner and where I can stuff his global supply chains. Production has its own challenges, but it's not rocket science. The critical key is that whatever we produce in the factories, where do we sell it? So if there's a credible partner and I can stuff his global supply chains, the options are still on the table, but we have not been able to tie up or find a global, what you call partner. And end of the day, if you see only Renesas has come into India apart from Micron, there are no other players like NXP, ST, TI, onsemi, and other people. None of them have so far decided to put shop in India. Once it crystallizes, then we'll share it with the market. But currently, there is nothing concrete on the table.
So can I, sir, assume that this is for the moment unlikely? It's on a back burner at this point.
Even if a decision is taken before the revenues kick in, it will be a year to 2 years from the day we start. So yes, currently it's just under the negotiation and scouting stage. Nothing concrete on the table.
Well, that was the management of Syrma SGS. They are looking to, of course, looking at the OSAT vertical, something very difficult for all Indian players, but largely the industrial, the automotive, as well as the healthcare, these three verticals is what the management highlighted. We've given it a KYC rating of 6 out of 8 for this particular company. But that's all the time we have on this edition of Know Your Company. Thanks so much for joining in, and we'll see you tomorrow.